Bonjour les amis, today I want to make a video of online casino financial model. This one may be interesting to those of you who want to start online casino who already have an MVP, and for those who want to invest online casino. So I insist on usage of unit economy here in modeling of online casino finances. If you look there, you will see that the revenue stream is built of number of units sold and the price per unit. Here in the world of online casinos, we take them for number of new depositing customers or first-time depositors, whatever you call them, as well as their lifetime value per quarter. So why we even say new depositing customer or first-time depositor? This is done to emphasize that we have to take caution to correctly address them within the balance sheet, within our financial statement, because each customer, each player has to be counted as an actual unit only when he makes his or her first deposit and through the lifetime. Here, for simplicity, we take a lifetime value of 4 quarters or 1 year only. After that, we consider that the lifetime value is exhausted completely. So whatever a player brings after shall be attributed to the lifetime value of the second customer or the next customer. All right, if you look at the expenditure stream, you will see that most of the time it's built through fixed and variable expenditures. So fixed expenditures is something that you incur no matter what you do, no matter whether or not you bring new customers. It's mostly your salary to the core team, rent, and other expenditures that you would incur daily. The variable cost in turn, this is something that can be clearly attributed to the number of units sold and number of customers made. So it means that these are really comfortable to calculate. So for example, it includes marketing function, expenditures, likewise cost of acquisition of customers, and so on and so on. So the trick here is to be able to correctly attribute all the things that you have, all the numbers predicted or real that you have on your balance sheet, to fixed or variable expenses, break them down to LTV by quarter, and accurately calculate number of your first-time depositors. So I will leave a link to online casino finance model that I've built, and I recommend it for usage. It is free. You can download it by link. It's a Google Sheet document. If you want, you can make a copy of it, not to edit right away, because someone else may also load it too. But the idea is that the financial model is available for free, except for you may need some additional ideas on how to use it. So the model is rather simple. It contains 4 parts. First is revenue build, then income statement, product operation ratios, and business operations ratios. So now that we see the revenue build, we may discover what are the costs of running a business, what are the margin of sales, and what is the growth potential of this business. So this revenue build part contains number of FTD or new depositing customers, the LTV by player by quarter, and then cost fixed and cost variable. Cost fixed are something that's necessary for running the business, and cost variables contains of 2 streams. First is a cost of customer acquisition or CIC, which is a prepayment, or CPA, which is a cost per acquisition per se, as well as the other part of variable cost, which specifically applies to online casino and is called revenue share. So when we say the number of FTDs, we say LTV, we see the total variable cost and total fixed cost. We have the revenue built like this. Alors, so we are talking about next one, and next one is income statement. So here in the income statement, we have revenue, fixed cost, variable cost, and resulting gross profit, as well as selling goods and advertisement costs. So in this order, to arrive at the revenue, we multiply number of FTDs by the LTV quarterly. To arrive at the fixed cost, we take the part of overall fixed cost that we attribute to a specific quarter, and to arrive at the variable cost, we calculate a total of cost of customer acquisition, that is to say prepay plus cost per acquisition, CPA, together with the revenue share part of the marketing cost. What we have is we subtract from revenue the fixed cost, the variable cost, and this is how we arrive at the gross profit. And it is then from the gross profit that we subtract the variable SG&A. This is a platform fee, actually all the fees that you pay as an operator for running all the casino platforms, as well as other costs, for example, costs for retention, selling expenses, and so on and so on. So if you look at this file, you'll see the income statement, the revenue is growing significantly quarter by quarter. So to find out how, you would click on the cell, see that effectively this is done through multiplying the number of FTDs by quarter with the LTV by quarter. But what's interesting is that as we discussed, the duration of lifetime of player is 1 year. So effectively, the LTV is added up or aggregated quarter by quarter until it's ended or fully exhausted in the end of the year. So it means that after the quarter 4, quarter 5, the growth is stabilized and the margins are flat. It's the time to realize all the gains, and this is where you will see the flat margins that we are talking about. So if you look here, the fixed costs are distributed evenly, the revenue is galloping because it's built through aggregated LTV by quarter, and the variable costs also the same, they're galloping because all the time it's aggregating the share of revenue and the prepayment of CPA of new players. So the gross profit comes from negative, obviously to positive, and then stabilizes around certain amounts. The expenses for platform and selling also are connected to revenue because they constitute a portion of your revenue also. So here in this model, we obviously use some numbers, they're close to real for some geographies. You may have your numbers, nevertheless the result will stand through. So the next is key ratios, and the first of them is product of operations ratios. So now that we've done financial model from revenue, bills part, and income statement, we want to look at the indexes or ratios, what is the relations between the numbers that we have. So here in the product operation ratios part, we have units growth, or how the number of customers or units is growing by period. The pricing growth, or how the LTV, or what we earn from each customer, is growing by period. Then ROAS, or return on advert spend. It is the relation between the variable costs, which are essentially advertisement for us, and the revenue. So it says how effectively we leverage the variable costs or advertisement costs in order to arrive at the revenue. So then this is a gross margin. Gross margin is one of the most important ratios here, and it says it has the relation between gross profit and the revenue. So it actually tells us how much money from revenue we can retain as a profit, less fixed costs and variable costs. Finally, these are two more ratios, LTV by CAC and unit contribution margin. So LTV by CAC, it shows relations between how expensively we bought a player or a customer as relation to their lifetime value, which portion of the lifetime value the player brings us after we have paid money for acquiring him or her. And unit contribution margin shows us how each unit, or in our case a customer, helps us cover the fixed cost. This is the cost of paying rent, salaries, and so on and so on. So this is basically the ratios that you want to know looking at the casino financial statements. What may be a practical application of this financial model? I think of at least 3 cases where this can be really useful. First of them is that suppose you've been invited to become an investor of already existing online casino. So what you might be interested in is overall reasonability of how their financial model stands against your understanding, and is their projection of ROI is even plausible, is even realistic. So this financial model can give you some answers too. First, is their pace of rising a customer base is realistic? What is the LTV that they put into the model? What is the average? What's the LTV that they claim? And finally, cost of customer acquisition. What is their amount? And what is the structure of their cost of customer acquisition? What portion responds to prepayment, CPA, and per share part? The next case is that suppose you are a person who wants to start a casino himself or herself, and who's looking down to different proposals to numbers from online casino platforms. And the question that you put to yourself is that, is this business going to be profitable after all? So vis-a-vis the platform fees. So the focus area of your efforts might be the gross profit versus the variable costs, as well as other costs of selling and running a business, including the platform fees. So the answer to note here is your ability to bear the minimal level of marketing requirements, marketing costs, cost of customer acquisition in order to retain the profitability, or in order to realize the profitability over the numbers. And the second area look at is the ability to cover required amount of expenditures, including the platform fee, if you're even able to cover these fees. And the third moment of application is, for example, when you're trying to scale up. For example, you've already built your casino and you want to scale up or jump to the next level right away. So this financial model will give some answers to the point of better understanding your affiliate teams or overall your customer acquisition team's effectiveness.